Hello and welcome to Stockwatch Live. Online fashion retailers could be on the brink of a £2.5 billion returns explosion as the trend to buy an item, photograph it, stick it on social media and return it reaches a peak during the festive party season. With 1 in 10 UK shoppers openly admitting to buying clothes and sending them back as soon as they've posted the pic on social media, estimates are that the trend will push the value of items returned up by £300 million this year. The peak returns days are likely to fall on the 4th and 9th of December following the Black Friday sales, and then again on the 7th of January. Online fashion retailers are set to be the hardest hit, with returns over the Black Friday weekend expected to top £457 million and placing a significant financial hangover on retailers who are unprepared. Very much an unknown quantity, returns over the Black Friday weekend alone across all UK online retailers are set to hit £606 million. It's a problem that all online retailers are aware of and are taking steps to tackle. While ASOS has threatened to block serial returners, Quiz is taking a different approach, hoping that if customers pick the perfect items, they'll keep them. It's teamed up with a technology company to provide personalised fit ratings and size recommendations based on each consumer's unique body shape and preferences. They say this will help reduce the friction and disappointment felt by a customer when a garment doesn't fit properly, reducing returns. I suppose time will tell whether that does the trick, but shareholders will be hoping Quiz has found the solution at a difficult trading time for UK retailers. Quiz shares have been treading water since September, and still at just under 17 pence today, they haven't made any sustained headway. In fact, since they plunged in March after yet another profit warning, they remain more than 90% down from where they floated at in 2017. The fashion retailer, which posts half-year results on Wednesday, has already said it expects to post a 5% fall in first half revenue. The numbers are forecast to come in lower than last year's £66.7 million at £63.3 million. Not helped either by revenue at its actual stores and concessions, which have fallen by a worse than expected 11% to £31.3 million. The company, though, insists that its flexible business model and increasing online focus will mean it can return to sustainable, profitable growth in the medium term. But if things don't appear likely to be looking up anytime soon, Quiz may well find it has some tricky questions to answer. Now, one company that should benefit from the rise in online shopping and the shift away from the high street is packaging company DS Smith, which posts half-year results on Thursday. A supplier to the likes of Amazon, Next and IKEA, it saw profits boosted by nearly a third last year, which prompted it to raise its medium-term margin targets to between 10 and 12%. It has recorded a 10.2% margin so far this year, beating guidance of between 8 and 10%. However, as paper and packaging company Mondi has already flagged up, generally softer demand and prices for key paper grades that were below those of the first half do threaten to have an impact. Back in September, DS Smith said it expected its full-year financial performance to remain unchanged, although it acknowledged that volumes were being impacted by economic uncertainty. That confidence came despite ongoing subdued volumes in some markets, in particular those economies with significant export-led market exposure, including Germany. Broker JP Morgan Cazenove recently reiterated its overweight investment rating on DS Smith, but cut its price target from 440 to 420 pence. UBS remains neutral, but has raised its price target 8 pence to 358 pence. Finally, on Friday, we'll get a half-year update from house builder Berkeley Group. Like others in its sector, profits at Berkeley have risen sharply since 2012, while share prices have soared. Back then, they were trading at under £12. Today, they're £45 plus. But there are signs of strain, with the industry facing a triple whammy, with Brexit, a potential global property downturn, and the end of the government's Help to Buy scheme, all threatening to leave their mark. Perhaps the biggest threat now to Berkeley and its main rivals, Barratt, Persimmon and Redrow, is if the economy were to slow just as the Help to Buy scheme winds up. The equity loan programme is restricted to first-time buyers from 2021 and set to come to an end in 2023. London and South East-centric Berkeley had suggested it would widen its net to protect against a stalling market in and around the capital. However, it said the current financial year has started positively, with market conditions in London and the South East robust during the first 4 months. It did, however, say the wider market remained constrained by high transaction costs and the uncertainty in the macro-political and economic environment. So shareholders will no doubt want to hear more about whether Barclays plans to continue to stick to familiar turf or venture further afield. Net cash at the half-year stage is expected to be at a similar level to the full year at around £975 million. And the builder is aiming to see pre-tax profits topping £3.3 billion within the next 6 years, with the annual figure coming in at between £500 and £700 million. HSBC has just downgraded its investment rating on Barclays Group to hold from buy. Goldman Sachs rates the shares a sell and has cut its price target from £39.53 to £38.60. And that's it for this week. For more on these and the other companies reporting in the week ahead, go to the Markets and Insights section at fidelity.co.uk.